Payroll tax in Australia is a state and territory tax that employers must pay on the wages they pay to their employees. The tax is calculated as a percentage of the total wages paid by an employer, and the rate varies between states and territories. Firstly, it is essential to understand the payroll tax threshold, which is the minimum amount of wages an employer must pay before they are required to pay payroll tax. In Australia, the threshold varies between states and territories, but most states have a threshold of around $700,000 to $1 million per year. To calculate payroll tax, employers must first determine their total taxable wages, which includes all wages, salaries, and other forms of remuneration paid to employees. Then, they must subtract the payroll tax threshold from the total taxable wages to determine the taxable amount. The payroll tax rate is then applied to the taxable amount to calculate the tax payable. For example, if an employer in New South Wales has a total taxable wage of $1.2 million per year and the payroll tax threshold is $900,000, the taxable amount would be $300,000. If the payroll tax rate is 5.45%, the payroll tax payable would be $16,350 per year. Best practices for managing payroll tax include keeping accurate records of wages and tax payments, ensuring compliance with state and territory regulations, and taking advantage of any exemptions or concessions available. Employers can also use payroll tax calculators or consult with tax professionals to ensure they are meeting their tax obligations. It is also important to note that payroll tax rates and thresholds can change over time, so employers must stay up to date with the latest information to avoid any penalties or fines. By understanding payroll tax and following best practices, employers can ensure they are meeting their tax obligations and avoiding any potential issues.